Hi guys, this is Dan from the Investment ABC, and in this video I want to talk about the Fed-driven run-up in stock prices today. Right now we are plus 3.1% on the Dow, 4.3% up on the Nasdaq, and plus 3.1% on the S&P 500. Did the Fed save the markets permanently? Should we go all in into stocks now? In my opinion, the Fed just said what we expected them to say early in December, that the Fed is data dependent and that they are carefully monitoring the economy. Powell said that they basically might change their policy when necessary. But that is nothing new. We know that at some point when the next crisis hits, they will reverse course and start cutting interest rates while shifting into QE. Powell stated in the beginning that we have low unemployment, a strong jobs report today, that wages are rising gradually, but despite all that, they were surprised that inflation is still low. He also said that on the other hand, the stock markets show conflicting signals. Maybe because the stock market is a leading indicator. Maybe that's the reason why it's showing conflicting signals. I don't know. The chairman stated that if the Fed has to, they will shift policy significantly. I emphasize significantly, whatever the significantly means. He said further that 2016 was similar, that they planned 4 rate hikes in that year, but didn't raise at all until the end of 2016. Maybe 2019 is going to be similar to 2016. Furthermore, Powell said that they are not seeing inflation and asset bubbles yet. I don't know what he's talking about, but I disagree. We could clearly see asset bubbles all over the world. That is why they were hiking in the first place. And in the end, Yellen and Powell said that the US doesn't have too many macroprudential tools left after saving AIG in the last crisis to deal with systemic risk in the banking sector. Maybe they are giving us a hint that the system is toast the next time we see a systemic crisis. Who knows? Ben Bernanke, he didn't say anything useful. So that's about it, what the Fed is thinking right now. They changed their views and forecast like the weather. I forgot it is called data dependent. Like I said, what the Fed says and what the Fed does are two different things. Basically, the Fed is saying right now they can't see asset bubbles and inflation yet. So when the economy weakens, we can start printing again until asset price inflation creates consumer price inflation. Maybe this time they figured out that we already entered the recession, or maybe not, and they will rise in March again. The last time President Trump gave them the perfect excuse to raise. Maybe this time he will do the same thing. Let's see. No one said anything about the flattening yield curve, giving us clear warning signals that we might see a recession in the next 6 to 12 months. If you haven't watched my video where I explain why the yield curve is such a good indicator for spotting recessions, I will link it in the end of this video. It is very important to understand that. There is also hope that we might see a real trade deal between the US and China. If this was the only driver for this rally today, I would definitely go short, since I believe it will take a very long time for an agreement. Now, how am I going to play this market now? If we have a look at this chart of the Dow here, we can see that 23,400 is a strong resistance, and we have to monitor if the Dow can break that level significantly. If yes, we might go very quickly to 23,800 to 24,000, where we have a high probability to resume to the downside again. The bearish trend is still intact, guys. The probability to break through 23,400 to the upside is higher in my eyes, but we will see. I can't believe the Fed is admitting that the economy is only strong if they artificially boost it. At some point, the wheels come off. The question is, what will trigger it? So, if you like this video, press the like button and subscribe. And like always, this video is no financial advice. Thanks, guys. See you soon.